going forward, I think that gold will continue this public participation phase. So I can see gold trading at 2,300, perhaps even higher next year, and that should mean a pretty positive environment for silver as well.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. Today, a bit of a special treat because I believe we're getting Ronnie Stoeferle's silver forecast for 2021, which obviously Ronnie, very well known in the precious metals world, writes the In Gold We Trust report. Also part of Incrementum AG, which you can find at Incrementum LI, and they manage some funds. So if you're navigating this mess and need some professional assistance, you can contact them there. And Ronnie, it's great to have you on the show today, dig into some metals and all the wild things that are going on. And it's nice to see you again. How are you doing today? Hi,
Chris. Good to see you. All good over here. We're in the middle of our second lockdown, and we're kind of getting used to it, but I really miss traveling, also business traveling. We'll see how it's gonna turn out, but I think it's been a good year for us. We're one of the few industries I would say that is doing well in this crazy and turbulent year. So I'm very thankful for that.
Yeah, well, I mean, again, I get it. I know a lot of people say, well, what conditions do we want to succeed under? Yet perhaps a counter to that is that life, nature, the planet is the way it is. If we change how we interact with it and do the best with what the conditions are. So with that said, a lot to dig into today, but why don't we start? We've seen silver sat below $20 for 4 years, then went up to 29, back down to 22, certainly has had a volatile week this week. What would you say, what do you expect for silver to do in 2021?
Well, I think it's been a tremendous year. We're now up year to date 35%, and we shouldn't forget. I think in spring, silver was trading for a few moments below 12, perhaps even below 11 US dollars. Yeah, I mean, I have to say I sometimes really forget about all the crazy stuff that happened in spring. So I actually wrote a journal and a diary to just remember all the stuff that happened in this year, because we really made history, it seems. So I think coming from those levels up to 23, 24 where we're trading now, that's been a pretty decent performance. Now I think that gold has taken a breather over the last couple of weeks, which was pretty interesting because we saw an extremely weak US dollar, but gold was also trading pretty weak. So we had a positive correlation between the US dollar and the price of gold. And also we saw that gold and real rates were kind of diverging. Now it seems that the worst is over and we're getting back to normal now that options expiry is in. So I would see gold trading higher over the next couple of days until the end of the year. Normally we've got a very strong seasonal pattern in December, and that should normally be a pretty good environment for the price of silver too. Now, Chris, I'm always a bit hesitant to give exact forecasts. I used to work in a bank, and you kind of have to do it there. Yeah. But so let me just tell you and your viewers, I think we're really in a stealth bull market in gold. I think this is really the most important takeaway. Now, what should you do within the course of a bull market? You should buy the dips. And it was interesting to see that so many diehard fans and I don't like the term gold bug, but you know what I mean, really got nervous over the last couple of weeks, and we saw that sentiment was cooling off quite dramatically. Now I think this is kind of over. I think we've seen some sort of panic. For some reason, gold sold off dramatically in very, very thin trading on the Friday after Thanksgiving. We know how that works. But now it seems that the market is kind of cleared, and I think, you know, the worst is definitely over. Now, going forward, I think that gold will continue this public participation phase. So I can see gold trading at 2,300, perhaps even higher next year, and that should mean a pretty positive environment for silver as well. I can imagine that we're trading up to $35 because, let's face it, when it comes to institutional demand, nobody is really invested in silver yet. And it is no coincidence that in our last, you know, that's the 2020 edition of the In Gold We Trust report, for the first time in 14 years, we wrote a special chapter on silver, where we outlined the supply-demand picture that is very, very appealing to us. We also write why silver, from a relative basis, is extremely interesting compared to gold. So yeah, I think it's going to be a good year going forward for silver, and therefore I think, you know, $35, why not?
Well, that sounds good. And I guess one of the levels that people look at, certainly I look at, talk about every night here, but I remember the days of $50 silver. In fact, you see my backdrop today. This was my post where I was trading options on the New York Stock Exchange. Ronnie, I wish you had been there to come explain silver to Tony on the left and Fat Frank on the right there, because I was trying. Nobody else wanted to hear it. But again, to me, seeing silver hit $49.50 in 2011, and, you know, I'll pull up in a second the Fed balance sheet. I mean, we were given this idea that the Fed was normalizing, which never really happened. And now, you know, you have Corona, you have stimulus left and right. So perhaps, do you think $50 silver, maybe not next year, but at some point, is an inevitability given what these central banks are doing and where the debt loads are at?
Well, I would say, you know, normally silver outperforms gold in a gold bull market. So why should it be different this time? And in our last In Gold We Trust report, we said at the end of the decade, we expect gold to trade at $4,800 based on our monetary model that we explain in the report. So, you know, $4,800 for gold, and the gold silver ratio at, let's say, 40 or 45, which is the long-term average, then I mean, you can do the math. So I think that the triple digits are clearly possible going forward. I know at the moment this seems like a crazy call, but I think this bull market had really just got started, and we saw this year in gold that you know, this whole train started to move, and once we get momentum in the gold space, we will also get at some point lots of momentum in the silver space. And I don't have to tell you how tiny this market is, especially when institutional demand is coming into the silver sector.
Yeah, I couldn't agree more. And I'm going to pull that balance sheet of the Fed back up again. Because, Ronnie, it's interesting. Here's 2011. Let's say September 2011, that's when gold hit 1,900. And you see the Fed balance sheet, 2.8 trillion now over. So, I mean, it's basically tripled. And it's interesting, between 2011 and last year, we saw the metals get clobbered because Ben Bernanke, Yellen, they talked a lot about tightening, As you can see here, they didn't really tighten anything. So I guess when you say $2,300 in gold seems extreme, or $4,800 by the end of the decade, again, not that the world is going to react like this, but just when you look at these levels in 2011, look at what's happened to the money supply. I think what you're saying makes a lot of sense.
Well, I think it's not outlandish to say that the balance sheet of the Federal Reserve will reach 20 trillion over the next couple of years. I think, just this year we created 50% of all the money that was created previously in the history of the Federal Reserve since 1913. So everybody's talking about flattening the curve and exponential curves, and I would say that's pretty much an exponential function. But Chris, this time around, it's not only narrow monetary aggregates that are basically going through the roof. We also see for the broader monetary aggregates like M2, M3, they're growing at like 30%. And this, from my point of view, is the big difference compared to 2008, 2009, where basically M2 growth rates were collapsing. Now they are up 30%, which is even higher than in the highly inflationary 1970s. So I think this the current setup is completely different to the great financial crisis, and there are many signs telling me that inflation really is around the corner. I think 2020 will go down in history books as the beginning of the crack up boom. And I think, we just released a special report about inflation. It's called The Boy Who Cried Wolf. And I think that markets are already telling us that they're seeing inflation developing. I mean, let's have a look at all inflation sensitive assets, commodities, agricultural commodities, base metals, precious metals, of course, but also the tips market. Have a look at currencies. I mean, the US dollar looks really, really weak, and normally a major bear market in the US dollar is some sort of always a confirmation for an inflationary environment. Now, I think we're now seeing really this, I call it the reverse Paul Volcker, because Paul Volcker back in the days, his job was basically to kill inflation. And, he put a cap on monetary growth. He aggressively raised interest rates. I've heard that car dealers sent him coffins full of keys of unsold cars because he triggered a pretty bad recession. And now we're seeing completely the different thing. We are seeing desperate central bankers that want to create inflation, more price inflation. And I tell you, now 2% is not the ceiling. 2% is our target that we want to achieve on average. And now, as inflation rates were undershooting, now we want inflation to overshoot for a couple of years, and then we'll contain it again. So, I mean, if that's not the best advertisement for holding gold, silver, and probably also Bitcoin, I don't know what is.
Well, I'm going to try and see if I can answer that question. What could possibly be a better reason for that? Maybe they didn't teach this one. Ronnie, I don't know if I told you before, I went to Wharton for an MBA, which was an eye-opening experience. I wish I had saved the receipt and could return it, because things they don't mention there that I'd love to get your comment on. 10-year Treasury yield rises. Like, wow, rises a big level, almost a full percentage point. But I'm thinking, I feel like I remember just hearing you say that we had an inflation target of 2%, and they thought that wasn't big enough. And there are people saying, are we going to have negative interest rates? Don't we already have negative interest rates here in the US?
Yeah, of course. I mean, real rates are deeply negative. And I don't know what they teach at Wharton. I just did a semester abroad at University of Illinois, Urbana-Champaign, and I don't remember too much, to be honest, because we're partying like crazy most of the time. But I think that I still have some common sense that my studies didn't destroy, and I think, you know, seeing 18 trillion of bonds trading with negative yields, it just tells me, you know, if inflation really becomes a concern for financial markets, I think there will be an exodus out of those bonds. And I think, you know, what's the natural beneficiary? What's like one of the most reliable inflation hedges that mankind knows? I think it's gold, it's silver. So I think that, you know, there's many people telling us, well, you know, inflation, you're making this case for a while now, and we said no. I mean, we always said that we already have massive inflation, but we are primarily seeing it in asset markets, you know, the stock market, bond markets, real estate markets, the art market, all trading basically at all-time highs. Now, that's, from our point of view, that's a sign of inflation. But now we're really at this stage where price inflation, which is measured by those weird indices and government statistics like, you know, PCE and all those calculations, is measured. So I think, you know, just because of the base effect, next year in spring, we will see inflation rates probably at 3.5%, perhaps even 4%. Then we should not forget that this whole trend of deglobalization that every politician is now recommending is an inflationary driver. Then I think we're in a full-fledged bear market of the US dollar. Normally, that's really an inflationary driver. We should not forget that now, this time, if we compare this crisis to the 2008-2009 crisis, it is massive monetary stimulus, but it is also unprecedented fiscal stimulus. Just to give you a number, in Germany, fiscal stimulus is 10 times bigger compared to 2008-2009. In Japan, it's 9 times bigger, and in the US, it's 4 times bigger. So what governments created recently is almost 30 times larger in today's value than the Marshall Plan. So those are really big numbers. And I think that we should not forget that this kind of flirt between fiscal policy and monetary policy is now really becoming more than a flirt. It's a love affair, or probably a marriage. And I think one big taboo really has been broken recently, and this distinction between central bank policy and fiscal policy is perfectly shown by the nomination of Janet Yellen as the new Treasury Secretary.
We got the wedding ready to go. We got Janet Yellen in there, and she can marry up to Biden. And I mean, it's incredible because we used to hear like that people were concerned if the politicians were putting pressure on the central banks. But now you hear Powell all the time saying, "Oh, we need more stimulus. We need more stimulus." Now they have a ex-Fed chair in the White House. A little wild.
It is a little wild, and I mean, Janet Yellen, I have to say, I'm not the biggest fan of hers. She trained under James Tobin, and you know, if you study James Tobin, he's always been in favor of easy money, of social spending financed by tax increases, very Keynesian policies. Now, I think that's, the symbolism of Janet Yellen being nominated is it cannot be overestimated. And if you read or listen to important Fed members, they sometimes sound like social workers nowadays. And I think this kind of virtue signaling, okay, we have to help everybody, is something that concerns me quite a lot. But it is just the logical next step. So I always said that if Joe Biden should win, Stephanie Kelton will become one of the most important players in economics, and yeah, I mean, everybody should read the book by hers, The Deficit Myth. And I think this is really another taboo that has been broken. And in German we say, ist der Ruf einmal ruiniert, lebt es sich ganz ungeniert. And I was told that the translation is, once your worldly reputation is in tatters, the opinion of others hardly matters. Now, what I want to tell you, Chris, is that the whole narrative around deficit spending has completely changed. Over here in the Eurozone, we had the Stability Pact, the Maastricht criteria. Now everybody, especially the French and for some reason also the Italians, don't know why, are saying, nah, screw it. After the COVID crisis, we won't go back to the Stability Pact. Nobody really cares about the Maastricht criteria. So all budgets hawks have been completely silenced, and I think this is really the big paradigm shift that we saw in 2020. This move from, okay, over the long run we should have a kind of balanced a budget, to, well, screw it, nobody cares anymore.
Yeah, well, I've heard a rumor. I don't know if it's true, but actually the main thing Janet Yellen's planning to do on day one, I heard, is get Ben in his helicopter, send him out to fix everything. Ronnie, you mentioned a very interesting point when you're discussing inflation, because you mentioned the housing prices have gone up, and I'll be the first to admit, based on what happened in 2010, I thought we'd already have like the $20 slice of pizza, which fortunately has not happened yet. You mentioned how the metrics the governments use are not the most accurate, shall we say. And again, I love that you mentioned the real estate, because I'm going to pull this one up. Here's the Case-Shiller Home Price Index. Here we are back in 2006, 2007. So you can see we're well past that. And the Fed sells higher home prices as some virtue, which, sure, it's great if you already own the home, but imagine, you find your sweetheart in college and you're getting married, you're graduating in the early 20s, not so good for them. And I mean, it's, for a lot of people, almost probably seems impossible to ever own a house. So I think you're quite right. There's plenty of inflation. It just, they give us measurements that don't include it.
Yeah, of course. I mean, I think lots of paper wealth, of course, was created this year, but it's as the name says, it's mostly on paper, and this is what this crack up boom, or in German the term is even nicer, Katastrophenhoss, that Ludwig von Mises describes what it tells us. And to take it to the next stage, this would also mean that at some point, and it's impossible to forecast this point, at some point people will just lose confidence in paper money. Now predicting this point is, as I've said, impossible, but we know, in 2019 the leitmotif of our report was the erosion of trust. And the thing is, trust is highly asymmetrical. An example is, are you married, Chris?
No.
No.
I haven't figured that one out yet.
But imagine you're married for 40 years.
I'll think about it hypothetically.
you're building up trust over the years, and then you come back from work a little earlier, and you see your wife, in the bedroom with the neighbor, or the plumber, or the tennis instructor, whatever. I think this loss of trust, and the trust that you've built over 40 years will be will be done pretty quickly, and I think this asymmetry of trust is something that is that makes the whole situation so interesting. And I think the fact that there's so much capital going into the gold market, also into real estate markets, into the equity markets, because let's face it, Google, Facebook, Microsoft, whatever, they are the new island stocks, as they called them many decades ago. So stocks that you can basically buy and travel to an island, and you can be sure that those stocks will do well. But this is a sign that market participants prefer real assets over paper assets. And therefore, I think that we're like in a very advanced stage of this whole process, and that at some point, really, people will entirely lose trust in the US dollar, in the euro, in whatever paper currency. And I think that this and that's really something that I truly enjoy at the moment, that many people, especially young people coming from the more tech side, or more geeky side, over cryptocurrencies, are finding out about money creation, what sound money is, what the virtues of sound money are, why inflationism is messing up the whole world, the distribution effects of our monetary system. So I think although many people in the gold and silver industry are extremely critical when it comes to Bitcoin, but I think it's important, because we're reaching an entire new set of people that now learn more about money, and I think this is something that you probably were not taught at Wharton. What money is, and where it's coming from, and how sound money changes our society.
Ronnie, the Wharton classes had a much more Keynesian flavor, shall we say. Do you know who Jeremy Siegel is?
Yeah, of course, yeah.
Stocks for the long run, which I'm not trying to be mean, although I remember there was one day I was watching a video. He was one of my teachers there. And that was in 2004, because all the second-year kids are like, if you want to get a job in trading, you got to take his class. And I remember he was saying, hey, when the economy's weak, the Fed does its open market operations. Then years later, once I finally understood what propaganda all of it was, it's like kind of like Ben Bernanke mixed with Doc Brown from Back to the Future, because he's got these wild arm gestures and talking this Keynesian. Although, Ronnie, one thing I noticed while you were talking about the mortgage chart, here, let's call this 1994, we're at a level of 80. And now today we're at 226-ish. So that's basically a triple in 25 years. Now, someone at home maybe can correct me, but I did some quick guerrilla math. And if inflation is 2%, I believe it'd just be 1.02 to the 25th power, gets me 1.64. So at 2%, if my math is right, a dollar would be $1.64 25 years later, not $3. So, again, it's worth looking in the numbers, and I agree with everything you're saying. One question I have for you, I noticed on your inflation report, given that we don't really know the numbers, I don't know if you've heard of Dr. Mark Skidmore, who calculated $21 trillion of undocumented adjustments in the Pentagon and the Department of Housing and Urban Development. So, I mean, God only, and if that's what they found, who knows what
Mhm.
they didn't find. Do you think if we knew the real numbers that the US dollar has already passed Weimar Germany?
Uh, good question. You know, those numbers are just
Adam.
they're just just to give you another one. Where is it? It's from the IIF. I don't have it here. Ah, there it is. IIF, which puts out tremendous reports on that situation. So at the end of this year, we're seeing 277 trillion. Now, by the end of 2030, they expect 360 trillion.
I'll take
Which
the
is,
over on that.
yeah. So you know, that's I'm you know, let's come back to the basics. I think when it comes to gold, one of the most important drivers, of course, are interest rates, and especially real rates. Now, already before the COVID crisis, I think you know, our debt pile was pretty high. You know, now after this, nobody cares anymore about debt and budget deficits. Now it's significantly higher, which means that chances for a monetary U-turn, for rising rates, are probably smaller than ever. So we've got nominal rates at least until 2023, as the Federal Reserve says. But I think Powell said they're not even thinking about raising rates. And now central bankers are telling us, well, you know, we want more inflation. We just, for some time, just to stimulate consumers, we really need more inflation. And the market is already showing us that it's really seeing inflation as a concern over the next couple of years. So that means negative real rates over the next couple of years, which is, based on our research, we crunched the numbers at length. This is the best environment for gold that you can imagine. Now, with debt going to 360 trillion by 2030, what do you think chances are that we will see significantly rising real rates over the next couple of years?
I mean, unless the bond vigilantes finally wake up and take control of it themselves, I don't see, to me, it's impossible for any of these central banks. It's so far past the point of no return, they can't.
No, it's like, you know, it's like, I don't know. I wanted to say that the US winning soccer World Cup, but that's I think chances are significantly higher. That's like, I don't know, a guy from Saudi Arabia winning
Come on, give us a chance, man.
a ski race in Kitzbühel, a famous downhill race. So that's, you know, it's basically zero, and you know, this should really be a very, very positive general environment for gold going forward. But now we're seeing so many other small pieces that confirm my views. Stuff like, you know, MMT now really happening. I always said this is like the wet dream for every left-wing Keynesian monetarist economist. Now this is becoming a reality. Stuff like, you know, helicopter ban. That's something that is just happening, and I have to bring this book up. You know it, Modern Central Banking Simplified.
Whoops, had my mute button there. Did he write his own book?
No, I got it. It's by Michael Pantzner. And somebody sent it. I don't know who this man or woman was, but I'm very grateful. You know, our friend Ben on the cover, and then you've got on the back, the US government has a technology called the printing press, or today it's electronic equivalent that allows it to produce as many US dollars as it wishes at no cost. Federal Reserve Chairman Ben S. Bernanke. And then I said, wow, that looks interesting. And And then I opened it, and it says, print money. Print money.
Wow. All right, we're getting those in the Arcadia store. I need some copies sent over ASAP.
And then it says, keep on printing.
Ronnie, does it explain? I don't know if after he left office he got this clarified. Maybe you could help out, but does it explain? He seems confused here.
Let me just end by saying that nobody really understands gold prices, and I don't pretend to really understand them either. Thank you, Mr. Chairman. Thank you very much.
well, I will send him a copy of our In Gold We Trust reports.
You seem to get it just fine, and I think it's fitting because if you noticed at the end, after he says one of the statements that is that the most fireable sentence anyone in any position could say, given that he's controlling the world economy. But I guess that's how Ben does it. And yeah, maybe you could send him the In Gold We Trust report, clear it up for him. Amazing he doesn't have any friends who get it either.
We've sent Alan Greenspan a copy of the In Gold We Trust report, and he wrote us a really a nice reply, and he said he really appreciates it, and he always loves studying good gold research, and obviously I think Alan's Greenspan, he definitely wrote, one of the most important essays that I ever read about gold. So perhaps he should teach Bernanke and now Powell.
Well, I got a question since you bring up the maestro, as they called him. I mean, I think everything he did before he was Fed chairman was great. Hanging out with Ayn Rand, talking about the gold standard. Did he happen to mention in his response why he did the exact opposite of that when he was in office? And then it's amazing that he even has the audacity to criticize Bernanke. I mean, rightly so, but seems a little bit hypocritical. And by the way, he was actually the graduation commencement at Wharton, although I skipped it and practiced the guitar that day, which hindsight, it's one of my most proud memories of going in.
Well, I mean, analyzing why he did completely reverse his views during his time at the Federal Reserve, probably many reasons for that. I don't know. Probably lots of pressure on him, and perhaps somebody had known some dirty secrets of him. I don't know. Whatever.
Yeah. Well, Alan, if you'd like to come on the show, give me a call. I won't hold my breath. Ronnie, I got one final one for you that might get some people riled up a little bit. I know crypto can be a dirty word in Silverland. I tend to see them as on the same team. I know at Incrementum, you guys have a fund that gets involved in the cryptos. Perhaps more specifically, we see Bitcoin at $19,000. Do you expect any correlation between the metals? Like one of them is going to pop and the others will follow, or what's your take on that?
Well, first of all, I think they're not enemies. I think it's just ridiculous. Making this how do you say this WWF, this wrestling competition that is just it's just made up. I think it's so ridiculous saying that Bitcoin is a competitor to gold. I think they're kind of related to each other. They're perhaps kind of cousins, but I think the most important thing is if there's an enemy, then it's fiat money, and I think it's, first of all, as a capitalist, I think that competition is something great. It makes products better. It makes it's something that we obviously need more also in the currency space. Now, why can't we just have a sober discussion about the advantages and disadvantages of Bitcoin and of gold? I think that, of course, if you talk like, our neighbor, he's like 11 years old, and his whole life after school is in Fortnite, and you know, those kids are playing basically 24/7, and for them, buying digital assets in this Fortnite world is something totally normal. So if old farts like we nowadays probably already qualify as, if we say now you need something tangible, you know, if you talk to young kids, tangible, I mean, that's ridiculous. They don't need a physical thing. And I think that based on the Lindy effect, I think that Bitcoin did a tremendous job and basically came out as the winner of this competition in the cryptocurrency sphere, because most of the other altcoins or shitcoins basically got dumped. So I think, you know, there's a place for both in your portfolio. We are doing it in one of our funds where we've got 75% physical gold and 25% Bitcoin. We're doing a rebalancing strategy. We're using the volatility of both assets, especially of Bitcoin. I mean, you being an options guy, you know how rewarding those things can be, especially in highly volatile markets. So that's how we do it. I think that, you know, going forward over the next couple of years, perhaps Bitcoin will steal some percentage points of the market cap from gold. But, you know, Bitcoin now is between 350 and 400 billion market cap, while gold is trading at roughly 10 trillion. So, you know, there's definitely a place for both. And as I've said before, just the negative yielding debt at the moment is 17 trillion US dollars. So if you put those big numbers into context, I think that, you know, people should just own both and hodl them. So I will probably, the point when I'll be selling an ounce of gold would be when real rates are at 3 or 4% again. I think we're I don't know if we're going to see that in the next 10 years, but I think
I don't know if we're going to see that in the next 10 lifetimes.
but perhaps I will once tell my kids, well, you know, I own some Bitcoin, and there's a, wow, you own the full Bitcoin, and I will tell them, you know, we owned lots of gold, and this was basically what saved us from let's say the currency reorganization, to be diplomatic.
That's a polite way of putting it. I like that. Ronnie, another great call as always. Perhaps in wrapping up, you can just let folks know where they can find you, find Incrementum, and stuff you're involved in.
Yeah, well, have a look at our webpage, ingoldwetrust.report, which is the webpage that is dedicated to our In Gold We Trust publications. So the report itself published in German, in English, and in Mandarin. Then we've got the compact version, we've got the chart books, and we publish specials like this special on inflation. They're all available for free. I published 2 books, one called The Zero Interest Rate Trap, and the other one is Austrian School for Investors. And then, of course, we offer investment solutions like investment funds and wealth management for private individuals, but unfortunately for really everybody but US clients, because yeah, that's what the law is like over here.
Well, fortunately, we have a global audience, and anyway, we'll have the link to that in the description field below. Ronnie, just as we close out, I don't know if you heard, but we're making a little bit of a silver December to remember party over here. So today, I have a 1.5 ounce silver maple leaf. And for anyone who would like a chance at winning that, go tag Arcadia Economic. And Ronnie's, if you type in Ronnie's name, you can find him on Twitter too. take the link to this interview, tweet it out, tag both of us on it, and you may end up with a nice silver coin. Great Christmas presents, right, Ronnie?
Absolutely.
Yeah. Well, thank you, my friend. Great to catch up with you as always. Can't even imagine what next year will bring, but I think people really appreciate hearing from you, and we'll do this again soon.
Absolutely. Thank you very much, Chris.